US market to exit a whole. I think it's so timely for me to address about this topic, as we could see that there's so much jittery in the market, especially the last few days. So allow me to just give you a framework of what I'll be covering the next 30 minutes. Now, first of all, I will take you to an understanding of why and what's the key reason for US rally over this period of time, especially the last 12 years since 2008. And in fact, the rally has been ongoing for the last coming to 40 years, since 1982. But in any case, we're going to discuss that. And I hope to bring you a lot of insight. And as I progress on the program, the next thing that I will introduce to you is a technique called mapping your investment, and it works for traders as well. You could apply this to trading, especially in this unusual time or normal time or growth period. It is applicable. So later on, as I'm going to share this concept, how to apply these strategies to investing and trading. And of course, I'm going to give you some case study. And we're going to take on the Apple, which is I just prepared today. Amazon, we're going to study Amazon, how to apply what we've learned on part 2 to part 3 for today's program, and Dow Jones as well. Then, of course, I'm going to go back what is HPQ. It's actually Hewlett-Packard. So I will use that as a very old classic example. You're able to see that what I'm sharing with you called the mapping of investment strategy that is so applicable, that is so timeless, that you can apply in any markets and it can apply in any stock market as well. So after that, with the understanding of the whole structure, with a lot of case study tonight, then we're going to take on to today, this season about the US market. So really with all this development, where I think recently in December, Federal or Jerome Powell just mentioned that next year, 2022, likely to have 3 rate hikes, and maybe in 2023 another 3. So we're going to examine that at the end of it to apply what we've learned tonight, whether at this moment the US market, is it to exit or to hold. So let me just mention about the mission that my company we have. Our mission is to bring an understanding to the marketplace. We hope to clear common misunderstood concept about investment and trading, equipping you with the right skill so that investors and traders will know when to take a calculated risk, and they will also know when to take a bolder risk between market danger and market opportunity. So what I'm going to present here tonight is not a recommendation, so please consult your licensed financial broker or advisor. Now, so what is the key reason that we see that US have gained from strength to strength over the last coming to 40 years, since 1982 to be exact, and especially over the last 12 years since 2008, after the Lehman crisis, subprime crisis? What caused the rally? What caused the US market to have this, it seems like, unstoppable rally? So is this rally going to be unstoppable? We're going to discuss that. But first, we got to discover about what is the reason behind all this rally in the US market. Now we could see that this is a chart demonstration here that from 2008 to current, where I just prepared this again, updated today, that we could see that since 2008 with subprime crisis, with Lehman crisis, the Federal came in with this help called the QE, and it was so successful that I want to make a point to let you see that in every quantitative easing, let me just shift myself up here, that you could see at any point of quantitative easing, the market comes supported and continue to move up. So basically, in short, quantitative easing is to support the bond market and also the MBS. And what is MBS? Now, let me explain here. Now, in the latest measure after the pandemic that hit the US somewhere in January or to March last year in 2020, then we could see that Fed came in with the 4th QE, which is that you could see on the low window that I say here that a federal monthly intervention of 120 billion US dollars, they buy up the bonds and also the MBS as well. And that really supported the market. And they have not just do that 1 month, but they are committed to do it every month. So if you're going to add up all the last year, the month, and this year as well, I just do a sum up, is about 2.5 trillion US dollars that the federal, that they have given commitment over this period to support the market, and it did help. Now, I want you to look at the arrow that I have indicated here. Now, it's just beyond just federal, but even the Congress have their intervention as well. You could see that Trump CARES Act intervention, that's about 2.2 trillion US dollars on 27th of March. Then followed by Biden, 1.9 trillion, American Rescue Plan, and the latest that we have will be on the infrastructure plan with 3.5 trillion US dollars. Now, I'm going to bring you a little bit more intimate to the chart. Let me just go to the next chart here. Now, you could see that with all these QE4 and the Congress intervention as well. Now, I want to look at the timeline that each time there's intervention, whether it's from Fed and Congress, it's so fine print that every time there's stimulus intervention, the market goes up. I just wanted to take your time to appreciate that. And then followed by Biden American Rescue Plan. You can pinpoint exactly where the low was and how the market reacted to it when the intervention came in, where the stimulus is being rolled out. Then we have this Biden infrastructure plan with 3.5 trillion US dollars. The market go up. It's supported somewhere around October this year, and then it go up again for NASDAQ and it hit the high. So now if you're going to ask me about whether the US market is going to continue its rally, my logic and my answer is very simple. So as long as the federal and the Congress has the ability and the trust to continue to issue US dollars, to continue to issue intervention or stimulus, I think the US stock market should be all right. So basically the whole idea, the whole investment strategy or trading strategy is that you always look to buy on dips, because as long as they have the ability to flood the market with US dollars, with fund to support the whole industry and the market should be all right. But something may have just changed where I think that's my whole motivation today to describe to you to, I wouldn't use the word unlock the mystery, but to really bring clarity to the marketplace, how we should look at the market. All right, let me just shift myself down. This is really fun. All right, now I think I just explained about the first part, the key reason for US rally. Yeah, it's all about stimulus. It's all about as long as they have the trust, the federal, the central bank, or the Congress have the trust to continue and has the ability and the capacity to continue to issue new dollars, liquidity, I think the whole US market should be fine. I think the uptrend will be continuous. Now, let me just look at this strategy where I really want to introduce to you, and it's so classic, where I've observed using this strategy since I came to the market. Of course, I don't use it myself, but for the last 3 decades, I observed the market. I would say for the last about 8 to 10 years, I've been adopting this strategy. And for the last 3 decades, I observed the market. I came to a conclusion that market can be quite, there's a mapping to it. Now, let me just introduce to you how this thing works with the example in Apple. Then later on, we're going to use the example in Amazon, Dow Jones, and as well as Hewlett Packard, right? Now, you could see that for this Apple chart, in fact, this technique is what I call the mapping your investing technique or mapping your trading technique. Now, I realized that through observation over the last 3 decades, there are 4 stages in most of the stock market and the market itself. Now, what are the 4 stages? The first stages are called the income stage or the range stage. Means that the market is moving sideways and nowhere. You don't see any trend. But before the market enter into a growth stage, that's most investors wanted a growth, or the traders wanted to have this uptrend. Now, before the market entered into a growth or uptrend, now this is what I coin it as the value stage. Now, by the way, my value stage definition is very different from maybe what you have known. But I hope to influence you to think maybe correctly, but I've been using that. Now, let me define what is my definition about value stage. Value stage is a point before growth. There was an initiative by the company or the market itself. It caused the market to have a new interest about to enter into growth. Now, I define that it is a company or market that are trading significantly below its fair value as it is about to enter into a growth stage. So from income to value is a trigger point. Yeah. Then after that, I'm expecting a growth. So whenever I see that there's a value stage, the stock market, a single stock market or the market itself, it can be a country that enter into a value stage, I'm expecting the growth to come. Now, if that market or stock market can continue to sustain this growth, they are relevant to the industry, they are relevant with times, I think the growth should be continuous. But there's always accident where this company may not be in line with the relevance of time, then they may enter to a decline stage. So for this example, I'm not suggesting that Apple are entering into a decline stage, but who knows if they have miscalculated on to tap on the high growth area, they have missed that portion. I wouldn't know, but let's study that more intimately shortly later. Now, let me explain further about in the growth stage. I think that's my topic tonight. After that, we're going to examine into the US stock market as a whole with the example on Apple, followed by Amazon and Hewlett-Packard. I'm going to demonstrate in a short while. Now, in the growth stage, mainly there are three parts to it. Now, what are the three parts? Now, my whole idea is that I want to present this case to you, this case study to you, so that you could understand that there are mapping technique. Then after this session, you can apply and on your own time and own target, at your own pace to recognize this progression from income to value to growth to decline. Even within the growth, I think something very interesting here is that there are three stages mainly. Now, what are the three stages? The three stages, they are beginning stage, which is pretty boring, and maturing stage, and followed by euphoria stage. Now, as I'm going to present to you the next few case study of Amazon, Dow Jones, and Hewlett-Packard, I want you to take a look at the characteristic between the beginning stage, maturity stage, and euphoria stage. There are a standard pattern. Now, I want you to take note of it. I'm not going to review to you until the end of it. Yeah, the final countdown. That on all these examples, try your best to identify the characteristic of each growth, the beginning, maturity, and euphoria. I hope you can identify it, but if you cannot, it's okay. At the end of it, I will tell you how to look into it, how to tell whether this growth is at the beginning, maturing, or it is at euphoria stage. Now let's get into the case study of Apple, Hewlett-Packard, Amazon, and Dow Jones. Okay, now let me just study into this very classic example on Hewlett-Packard. Now, for those that's about my age, about 49, I'm 49 years old this year. Next year, I'll be crossing 50. And in my 20s, yes, so you will agree with me that Hewlett-Packard then in the 90s, it was like the Apple in today's standard. You know, Hewlett-Packard was the Apple then, yeah. So it was in a growth stage. But I think they have not kept up with time. They have not reinvented themselves somewhat along the timeline. They fall back to decline stage. So that's what I'm seeing here is that you could see that the development of Hewlett-Packard in the 80s, it was an income, then value is a very short period. It's a trigger point is that the company is taking into an initiative to push the company forward into a growth stage. And if the company could sustain this growth, it's great for them. But if they could not, they miscalculated or they have not adjusted their pace to the market demand, then it may enter into a decline stage. So this is one very classic example. And let's look at Amazon right now. Okay, the market by Amazon. That you could see that now I freeze the screen here after about 2014. So later on, I'm going to share with you the Amazon up to today's market. So basically, in short, I just want to demonstrate to you that Amazon is still part of the growth, but I want to lead you to see that since the beginning in the 90s, we have a short lived of income stage or the range. The market is basically trading nowhere, is basically trapped in the range. Not necessarily that they'll pay you income. I just call it as income stage. But if it is at income stage and the company pay you dividends, I think that's great. Okay, so I just call it as income stage as a reference. Now they enter a period that you could see that it enter a period of value stage. Now value stage is there's some initiative that's happening that push the company forward to a growth. And they took it very well after the cross of millennium, it entered into a growth stage. Now, growth stage, you still remember what I mentioned earlier, how to recognize growth stage is that there are three parts: the beginning, the maturing, and the euphoria. Remember the homework I just gave you about a few minutes ago, that I want you to, as I go through the few case study, I want you to read into it, to study into, to recognize the characteristic between beginning, maturing, and euphoria. That will help you to navigate through. I believe that 2022 will be a very exciting and yet volatile and uncertain years, especially for the investment scene. Okay. Now, let's look at the Amazon right now. Before 2014, we could see that there was a beginning stage after value. It entered into growth. It was a beginning stage. Then it went maturing. Now, let me just move to the timeline right now. That you could see that beginning, maturing, and euphoria. Can you see that there's certain characteristic about this growth, the whole growth, not just on Apple, not just on Hewlett Packard, but it's on Amazon as well. Okay, so yeah, I hope you're enjoying this. So it's basically, I just want to point the investor and traders that there are certain patterns that we can recognize. Of course, tonight, given 30 minutes that I have, I don't have the time to really explore and peel off every stages. What does it mean? What's income, value, growth, and decline? But I think I give you a relatively good concept for you to take it through in your investment journey ahead. All right, let's look at the Dow Jones. I think, let me just share with you a little shortcut here how effective I'm using all this benchmark like Dow Jones, say China A50 index or STI, when I decided to put more fund into the particular stock market. Usually I will study into the benchmark, which in this case is Dow Jones. So basically Dow Jones is a very old index, and I like it because there's a collection of huge collection of historical data where I can really literally study into the behavior over the last 100 years. Now, by the way, a lot of my friends told me that, Konghao, don't worry, when I invest in the US stock, it will always go up. The reason why it is because look at this 100 years old chart, more than 100 years old chart. It has been always going up. So is it true that US market has been always going up? I would have to disagree with that notion. Now, if you look at it very closely, I presented to you here today as a log chart. So basically, log chart is measured by percentage gain and loss. So we were able to study into the market movement and appreciate better. Now, if you realize that before 1982, maybe start from 1910 to 1982, maybe I should just shift myself out of the picture. Yeah, that's good here. Now, we can see that from 1910 to 1982, basically the whole Dow Jones, it measured 30 stocks, average blue chip stocks of the United States. It hang around this range. That's why I call it income stage, between about 2005. So the mean line, the average line, if you just draw a straight line across, is about 2005. From 1910 all the way to 1982, it is about 2005. The market literally entered into a value stage to a growth stage today. It starts from 1982. When the interest rates start to decline from 1982, it reached a peak about 20%. That's US interest rate to today's low. So as the US dollars or US interest rates start to decline, asset class start to pump up. And I think the reason for the value stage, earlier I say that value comes before growth. It's quite acute. It's a short period of time. You have to recognize that what is the macro changes and couple it with some technical analysis. I think that would be fantastic. So if you ask me about, you say, Konghao, so what was the trigger back then in 1982 that caused US to enter from income stage to value and today's growth? So what was the value? What was the trigger point back then? I believe is the US dollars became a very recognized currency in the world, became a reserve currency. Of course, it took about 10 years to build this stature, right? This standard here, it was because of the crude oil that there was in early 1970s, where first time the crude oil is in price in US dollars. And it took a while for the world to recognize that the US dollars is precious. I believe it was because of that. And during the growth stage, of course, there are different stages. I will not want to get into it right now. We have beginning stage, maturing stage, and euphoric stage. Now, where is it? How could we recognize that for the US market? Let me just share with you the next slide here. Okay. Now, we could see that from 1982, just now an earlier demonstration, we recognize that the US stock market started to enter into a bull trend starting from 1982 and onwards. That between 1982 to before 1995 is at a beginning stage. And then we enter into an era in the 90s that US market is in the maturing stage. Then I would say that after the pandemic, the US stock market as a whole has entered into a euphoria stage. Now, by the way, when I say euphoria stage, it doesn't mean that you should cash out. I will continue to invest in the US market. It's just that you have to understand that it's a euphoric stage right now. I think a lot of assets are overpriced, overvalued, because investors basically are chasing after the wind pretty blindly. So it costs an inflated price to stock market, to assets, a lot of assets. So you just got to be very careful. It doesn't mean that it's going to come down anytime soon. It just means that prices, asset price are inflated. So you just got to be very cautious. Where later on, I will dissect further. I'll give you my recommendation as a strategy. So it's for your reference. Yeah. Now, so we are going to move on to the last part of the our segment here today. Very short one, but I think it's wonderful that I could just in this format, 30 minutes sharing. I could share with you what's happening to the US today. I share with you a simple concept about investment and trading. Then I give you some really good and meaty case study example. Then now we are moving into the actual market today. So for the current US market, so what is the strategy, if you ask me? Is it to exit or to hold, to continue to hold? Because many of us will have an idea that now look at 100 years, which I disagree is 100 years, which I only agree that US market started to rally since 1982, not since the beginning of the century, but 1982 or beginning of the last century. Now, let's look at the market right now for the US market Dow Jones. So once again, I think I have to shift myself up a little bit here. Okay. Now, we could see that earlier, I tasked you a little homework where you don't have to submit this homework. I say that when I present to you the Hewlett-Packard, Apple, and Amazon, and as well as Dow Jones right now, can you identify the characteristic of beginning stage, maturing stage, and euphoria? I think we're more concerned in today's market is maturing and euphoria. Now, how could you tell that the market is maturing and euphoria? How can you tell? Maybe I'll give you a last chance the next 30 seconds to examine what is the characteristic between maturing and euphoria. On this demonstration, it could be purely technical, but I also want you to, after that I explain the technical, I want you to include the fundamental reason as well. Is there any backup to it? So basically my investment and trading strategy if it is for investment, I will use technical analysis. In the different twists, I like to include behavior science or market psychology to how I look at the market using technical analysis. Now, as an investor, if I find that there's something interesting that's going on through technical analysis, it kind of give me a green light to make a purchase. I will also, as an investor, want to include the fundamental reason to back up my proposition. Why is it a buy or why is it a sell? But for trading wise, let's say I'm a bit on a shorter term. So basically, I'm recommending a two portfolio you have. If you are a very avid investor and traders, have a two portfolio, investing and trading portfolio. And for trading portfolio, I can purely use technical analysis. But it would be great to have some fundamental backup as well, because trading, basically, the whole idea is everything is come to a short period of time. Now, I think 30 seconds have passed, I think more than that. So have you recognized that what is the characteristic between a maturing trend and a euphoric trend? Now, I'm just going to review to you right now, not to keep you in suspense for too long. Okay, now do you realize that doesn't matter, do not be too rigid that it got to be 45 degrees. So basically, you could see that in maturing trend, the whole uptrend is pretty smooth. That's the whole idea. But how to recognize that the market is euphoria? It doesn't mean that it must be 75. So do not be too rigid about it. It's just a demonstration. Now they got to look at the last phase of this growth. Now, last phase of this growth, you discern that it could be maturing, but you have to make a comparison between the current growth and the previous maturing growth. Now, I could literally tell that this over the last less than 2 years, because the pandemic started for US about in March 2020, less than 2 years, they could see that less than 2 years, the market have kind of steepened the growth a lot. Now, basically, in short, how you recognize that the trend in part of the growth became euphoria. It is when compared to the previous trend, which is maturing trend, it is much, much deeper. Now, so basically, when the trend got really steepened, as an investor, I have to be very cautious. Now, so whether the US market at this point in time is to exit or to hold. Now, my idea is this, basing on the market, and especially since the Fed have announced what they're going to do next year. So it brings so much clarity. So from a transitory statement that he said that inflation is no longer transitory, it is inflation. Inflation is here to stay, and 2022 likely to see they are planning to have 3 rate hikes. Maybe that's at least, but things may change. They may heat up a little bit. Now, so basically in short, if you look at my first point here, in the euphoria growth, as a long-term investor, I will have to be very nimble with my investment. It means that I cannot leave any room for laziness, whereby I say that it's okay. US market will always go up. It's just part of the volatility. If it comes down, it will sure go up again. Now, I do not think I want to entertain this thought. If it is already euphoric or euphoria, with my long-term holding position, I have to be very nimble. Nimble means that once the technical and fundamental coincide that telling me that market is turning down, I have to be willing and ready to cash out partial or all the investment holding that I have in a particular stocks in US or as an index as a whole. Now, so at this time, market is getting a bit more exciting, definitely much more volatile. I will really enjoy trading the US market. That's the second part. I would prefer to trade the US market for some short term. Don't mind to short a little bit, which I just did about 2 weeks ago. So I waited for a while, and I think over the last 2 days, it kind of show me some result, give me some affirmation that I'm doing the right thing. But definitely on the first part, if you're a long-term investor, be mindful that you're in this growth is already euphoria. So be nimble with your long-term holding. So that's my recommendation for strategy. And the common question that I have before I give you some context, how can you continue to follow all this program that I have, is that the common question whenever I deliver this strategy, one question that I always receive is this question. Now, this will be very useful for you. The common question that I receive is that, you ask me about, will every market or stock market go through these 4 stages? Not really. It really depends on a particular stocks. Say, for example, the particular stocks is, they just want to offer a service to the whole industry or whole demographic, that they just want to offer a service, they want to create jobs. They have no desire to grow, because once you grow, you want to enter into a growth phase, that company will have to take certain risks. So some companies are just happy to do a social service. Whatever they get paid, they pay their staff. They like to, this considered social service. So you'll remain at income stage because the company mandatory, the directive, do not have a growth stage in place. Now, some company may enter into growth, but before growth, usually the market will enter into a value stage, where I defined earlier what is the value stage. It comes before growth. Now, there will be some trigger, some initiative that cause the market to, or the stock market to enter into a value stage. Now, but whether the company able to sustain through this initiative, this new idea, this new technology, maybe this new initiative, want to push the company to the next phase to growth. Now, the value stage became a very a substantial portion in these 4 stages, where I observed over the last 3 decades, that some company may able to sustain this idea, the trigger, and bring it to growth stage. But most of the company I observe, they have fresh idea, but they do not have the capacity to bring it forward into a growth stage. That it just kaput, it just die off from there. It just go back to its income stage. So it really depends. But based on my observation, if the company are outstanding, it will bring forth this company into the next stage of growth, into the growth stage. And then as the company started to grow, the market changed, trend, fashion change. I hope that this company will able to adjust all these changes to the company for continuous growth. If not, this company may enter into a decline stage. Now, I hope that you're blessed with what I shared tonight. And importantly is that I find that it will be helpful for you. And the next Monday that what I'm going to share is going to be even more exciting here. So I'm going to use the same techniques, the same strategy, but I'm going to place it over China and Singapore. So you're going to see how I use it, this technique that I have, how I examine into Singapore and China market. So this is what we're going to share next week. And as a point of connection, if you liked what I shared tonight, you want to continue to engage me or for me to engage you, that we can share a lot of information, do like or follow my Facebook page. Every day, I'll spend about 1 or 2 hours to read news, to digest them. Then after that, I do not want the news or the insight to go to waste. I would write a short note on my Facebook page. I'll post it anyway. So those followers and likes that I have will benefit from it. So do like or follow my Facebook page. The name is my name, Konhow, Konhow, joined together. So this was the latest posting I posted. That was 14th of December, I believe is last Tuesday, where I felt that Apple is some strange behavior that's going on there. That you could see that since November, there was inverted hammer. And then somewhere in the later November, there was inverted hammer again. And I could see that there was a bearish engulfing body. So all these are decoded using market psychology or behavior science. I just felt that in this uptrend that Apple is experiencing right now, I could see that there was a lot of cash out. How can I tell is through all this behavior? 2 inverted hammer, 1 bearish engulfing body. So though it gives me uptrend, but I could read into the market that it seems like there's a lot of cash out going on in Apple. So this was what my idea was. So 14th of December, I shared that to like the Facebook page that I have. And if you like what I shared tonight, go to Invest and Trade with Insights. You'll see my face there. You can subscribe and hit the bell as well. So with that, thank you for staying true for the last 30 minutes. I think I really enjoyed doing this, able to bring some understanding to the market to what is commonly misunderstood. So last, I just want to leave it to you that that value investing is never passive. Okay, so if you think that value investing is buy and hold forever, that's not called value investing. That's called income investing. Okay, so at least I have make some clarity there. I just want to wish you a Merry Christmas and a Happy New Year. Thank you.